I'm a non-orthodox economist. I have been since 1972, so I've got a head start on most of my contemporaries, and I'm trying to get economics, drag it out of what I call its Ptolemaic obsession with equilibrium and the Earth at the centre of the universe and epicycles to explain the planets, and get over to a Copernican vision where we accept it's non-equilibrium and dynamic and monetary. And it's a long struggle because I'm trying to get people who've dedicated their whole lives to having an equilibrium vision of the economy, thinking in non-equilibrium terms. I break the world into two types of economies. I call the walking dead of debt and the zombies to be. Now, the walking dead of debt are countries like America, Spain, the UK, to some extent Ireland, which all had crises back in 2008, slumped afterwards, and now they've got this huge anchor of private debt around them. They won't grow very quickly. The zombies to be are countries that managed to avoid the crisis in 2008 by continuing to borrow money. Australia's the standout example there. They doubled and trebled grants to people from the government to buy their first home, to restart a housing bubble. China did a similar thing. Those countries are the zombies to be because you can only do that for a while before you reach the ceiling level of debt the economy can carry. Varies radically between economies. It's in the case of America, it was 1.7 times GDP. In the case of the Netherlands, it's 2.4 times GDP. And those zombies, most importantly, include China, Canada is second in size after that, South Korea, Australia. So those are the zombies to be. So it isn't a question of when, it's also where. And my standout nominations are Canada and Australia, also South Korea, for where the next crisis is going to occur, and in the next 1 to 3 years, certainly. Okay, well, the US economy is moderately strong, but one of the main reasons it's strong, well, there's two major reasons it's strong. First of all, the level of credit, which is the annual change in private debt, creates an identical change in the money supply, which is then spent into existence and adds to demand. And that the slump in that from being plus 15% of GDP before the financial crisis to minus 6 afterwards is what actually caused the financial crisis. Now, after about 10 years of that, with all the government attempts to boost spending and the reserve cutting rates to zero for over a decade, you've now got people borrowing money again, and that increase in borrowing is roughly about 6 or 7% of GDP, and it's starting to flatline at that level. Now, that's giving you a reasonable boost on top of what QE has done to the economy, but it's recovering. There's growth occurring again. There's a bit of optimism coming back as well, but it's by no means robust. The main reason I see it as being fragile is with the level of private debt that was accumulated through the bubble of the financial crisis, only being reduced from 1.7 times GDP to 1.5 and now growing again. It's a bit like you're in the rarefied extremes of Mount Everest and you think you can take your oxygen mask off and climb up to the top again. I'm sorry, the two don't work together. So as the economy starts to get back to that peak level of debt once more, it'll run out of air and you'll start falling down again. And the reserve, by putting up interest rates, which it's doing in ignorance of the real economy, will actually trigger people going back to trying to reduce their debt again. Credit will turn negative once more, probably by about 2019 rather than during 2018, and the wind will come out of the economy as the Fed believes it's returning back to normal again. We're in a period of credit stagnation. The idea of secular stagnation becomes Larry Summers reviving a dead idea from Alvin Hansen in the 1930s. Hansen put the idea forward to try to explain why unemployment, which had fallen from 26% in 1932 down to 11% in 1936, then increased to 20% again in 1937. And at this stage, the economics profession had just given up. They'd put their hands up in the air. We don't know what the hell's happening. That's why they worshipped at the altar of Keynes when Keynes came along with the aggregate demand explanation. But before they came out, along comes Alvin Hansen and says that secular stagnation, which is caused by two things: population growth slowing down and a drop in the rate of technological change. Now, of course, this was before the baby boomer generation came along after the Second World War, and it's before we invented nuclear power, jet travel, computers, you name it. It was fundamentally what economists were doing is they were blaming the slowdown in the economy on families not having enough babies and engineers not having enough ideas. Now, fast forward to bloody Larry Summers, he comes up with the same nonsense. Yes, it's true, families aren't having as many babies before. So in that sense, there is a tendency for the total level of GDP growth to decline. But GDP growth per capita depends upon engineers coming up with new ideas. Now, call me crazy, but I think a rocket that lands on its own arse after going into outer space is a new idea. I think carbon fibre is a new idea. There's all sorts of new technological ideas still coming out of engineers. So I'm not going to blame engineers for the slowdown. The slowdown is occurring because aggregate demand is lower than it would be if we had what you might call a 1950s or 60s level of credit growth, because the Great Depression and the Second World War eliminated the private debt burden on the American economy that had been caused by the Great Depression. You began with a very low level of debt, and a very low level of debt you can take on more debt each year, and servicing it doesn't take much out of your income. So you got an aggregate demand boom in the 50s and 60s. That what gave you the golden age of capitalism. Now you're back in the dark ages of capitalism because that credit growth each year without deliberate attempts to reduce it means the debt burden gets higher and higher. It takes more and more years to repay the debt. You stop borrowing money and you get credit stagnation. So it's not secular stagnation, it's credit stagnation. And the institution that could do something about it very directly is the Federal Reserve. They could use their money creation capability to create fiat money to replace credit money and get us out of this trap. But their mindset is stopping them from doing what they could do. In other words, they're a sorcerer that has a set of spells that could end the problem, and they don't even know they've got the power. Well, the Fed stimulus has had several components to it. One is interest rates being set at zero for something close to a decade now, and that's unprecedented to have a level that low for that length of time. And if the economy was the sort of self-equilibrating mechanism they think it is, then that low an interest rate should have caused quite a substantial boost in investment. Of course, we haven't seen that. So we're not in the normal world. The second part of the stimulus has been QE. Now, QE, the old analogy of pouring champagne into a top glass and watching it trickle down to the bottom works pretty well for QE because 90% of the money ends up in the financial sector and only 10%, if we're lucky, ends up in Main Street. So the QE helicopter, as Michael Hudson puts it, drops money over Wall Street, not over Main Street. So every year since the financial crisis, pretty much, the Fed's been pumping $1 trillion of money into the financial sector. Now, if we're lucky, $100 billion of that has turned up in the real economy and stimulated demand to some extent. That's where part of the recovery has come from. But in both cases, the economy has not recovered. It looks like it's walking, but it's walking in intensive care. One of the main reasons we've been caught in this whole crisis is because banks only lend money for speculation these days. They don't lend it for investment, for genuine investment, anything like they used to do in the past. So if we go back to the 1970s and 80s, one of the major lines of bank business was lines of credit to large corporations. A company like General Motors would negotiate $100 billion worth of a credit allowance, like a credit card, with a number of banks, and that would use that to fund their working capital on a regular basis. They'd take out long-term debt for investment and so on. The banks didn't make enough money out of that, so they've basically shut down lines of credit, and all they do now, the companies have to issue their own commercial paper to get that money instead. And the banks are trying to make money out of lending for real estate speculation. They're probably lending for Bitcoin speculation these days. We need to get banks to stop lending for speculation and start lending for investment. So and that's where the major inefficiency has come from. We've got an enormous capacity to create money, but that money's been going into creating asset bubbles rather than creating new assets. And we need to redirect it so banks lend for genuine investment, and the government itself also, in its own capacity to invest, lends for things like moon trips rather than blowing up Iraq trips. One of the reasons we're in this situation is because the Fed doesn't understand the economy. And that might seem ironic to most people, except after the financial crisis, they've got a better clue that might be a seriously sensible statement. They understand a model of the economy in which banks' debt and money play no role, in which the economy returns to equilibrium after any shock. And they've stuck to that belief system even through the whole financial crisis, whereas to its credit, the Bank of England and even the Bundesbank have both begun to think rather differently about whether capitalism is inherently stable and whether credit can be ignored or not, as it's ignored in the mainstream models. So they're ignoring actually what the rest of us, of a gut feeling, think actually drives the economy. Our gut feeling is right, their models are wrong. Central banks obviously have an impact upon the economy, but what's pulling them down isn't demographics, it's debtographics. They completely ignore this. I mean, if I can use an Australian expression, I'm completely pissed off by having spent over a decade now publishing data showing the extremely strong correlations between credit, which is change in the annual change in debt, and unemployment in America, both before the crisis, during the crisis, and after the crisis. The empirical data is overwhelming that credit is what drives the economic performance. The Federal Reserve, because they're run by a bunch of economics PhDs from Stanford and Princeton and all the mainstream economic departments, they refuse to look at it because it's outside their priori notions that credit plays no role. Now, they've been ignoring undeniably powerful data for over a decade. So they could be doing a far better job. They could have used their powers to create money, to inject money into the real economy and require people to pay their debt down. And by reducing the private debt, we could have got out of this crisis on a permanent basis rather than being stuck in it all the time. So they have plenty of power, but they're like a sorcerer who doesn't understand her own spells. The Fed has a simple model in its mind, which is they think it's complicated, what they call a dynamic stochastic general equilibrium model of the economy. And I actually summarise that model in 3 numbers. They believe that the rate of inflation should be 2%, the rate of economic growth should be 3%, and the interest rate they have should be 4%. And they think that they don't know what caused the financial crisis still. They think it's an exogenous shock, but they think they're drifting back towards what they see as normality. So their long-term ambition is to get back to a rate of interest of 4%. I think they'll get nowhere near it. I think the Fed's going to aim to have about 3 or 4 rate rises over the year. So they'd likely to increase interest rates by, say, up to 1% across the course of 2018. Now, what they're not looking at and what will drive the economy in the other way is that's going to drastically increase the debt repayment burden on people who are currently carrying, on the aggregate, a level of debt equivalent to 1.5 times GDP. That will mean that people's expectations of returns decline. They'll decide to de-lever, or some of them will go bankrupt, de-lever compulsorily. And when they do that, credit demand, which is currently running at about 7% of GDP, will drop towards, say, 1 or 2%. And that's a pretty substantial drop in demand. And the unemployment numbers will start to go the wrong way. And the Fed will think, what the hell's happened here? There must have been another exogenous shock. This time they'll be the cause of the exogenous shock by putting up those rates for an economy where really the real important thing is not to increase interest rates. It's to reduce the level of private debt, reduce the level of leverage, and they're doing nothing about that. QE is an illustration that the government doesn't need to tax to spend, because the central bank is part of the government. Every year they've been buying $1 trillion worth of bonds off the financial sector. Nobody's paid any tax to cover that $1 trillion per year. It's just been made by double entry bookkeeping. They put $1 trillion in the bank accounts of financial institutions, and they say, okay, we now own $1 trillion worth of bonds, so their assets have risen. The reserves have risen, and they thought that would lead to more lending into the banking system. And that's been called out as nonsense by the Bank of England and the Bundesbank. Banks do not lend their reserves. But what it's meant is those institutions which used to have $1 trillion worth of income-earning assets now have $1 trillion worth of cash. What do they do with it? They buy $1 trillion worth of assets. Now, if that simply drives share prices up by $1 trillion per year, and it could have driven up by far more, then that $1 trillion will be money that goes into the people who currently own shares. They might sell those shares and realise $1 trillion in capital gain. They might then use 9/10 of that to buy other assets, shares and property and so on, and maybe $100 billion turns up in the real economy. That's my rough arithmetic for what's actually happened courtesy of QE. So what it's done is really caused the rally that both Obama and now Trump are taking credit for. If the Federal Reserve wasn't pumping that much money in, we wouldn't have seen anything like the level of share valuations we see right now. Of course, what I think is going to happen when they try to reverse QE is the process operates in reverse. So if you tried to buy, having bought $1 trillion worth of bonds every year, if you now try to sell that much back to the private sector, they have to sell shares to buy those bonds, which they will do. That will liquidate shares. That will cause share prices to fall. So I think the first thing which is going to make the Fed reverse direction on trying to reverse QE is a collapse in the stock market. When QE first started, I call it a pact with the devil, a bit like signing a contract with Mephistopheles, because once you've signed this contract, you can't get out of it. You can't decide, oh, let's reversal. What's the exit clause? There is no exit clause from a contract with the devil. One of the mistakes that the Federal Reserve has made is believing there's what they call a wealth effect, where they say, well, if people feel wealthier, they spend more money. So if we drive up share prices, that will stimulate demand because people spend out of their increase in wealth as well as spending out of their income. That has been empirically contradicted by a little organisation called the Federal Reserve. In doing analysis of whether there is a wealth effect out of shares and out of property, they found there's a tiny wealth effect out of property, but virtually no wealth effect out of shares. So the actual foundation of their idea of driving up share prices to cause a stimulus to demand itself is wrong. But they're so wedded to believing that the stock market can't be allowed to fall. This is right back to the Greenspan put days of 1987, that when they start trying to reverse QE, therefore they're selling bonds back to the private sector, which therefore has to sell shares to buy the bonds, and therefore share prices will start plunging. When that happens, the Federal Reserve will go into panic mode. When they go into panic mode, they'll either stop the reversal of QE and reduce interest rates, or they'll decide, okay, we've got to hold these bonds on our books till maturity and let them expire by old age rather than by selling them back to some other owner in the meantime. So I think they'll be forced to do two things. The first thing is the reversal of QE will stop, and possibly at the same time they'll cut rates. But again, I don't see that happening to probably 2019. I think they'll put up 3 or 4 rises in 2018 before they realise they're sinking the ship. Of course, the Federal Reserve is not the only bank doing QE. The very first was the Bank of Japan, and they've been doing QE on and off now for a quarter of a century. Then you had the British getting involved in 2009. The ECB, the only banks that aren't doing QE right now are banks like the Bank of Canada and the Bank of Australia and the South Korean, which, of course, they managed to avoid the crisis by restarting their own private debt bubbles with new housing bubbles. So I think QE is going to expand. The countries that aren't doing it right now are going to have a credit crunch, and that particularly the ones I identify as most likely to have a credit crunch in terms of size of economy: China, Canada, South Korea, Australia, and then a range of smaller countries like Belgium. They'll have credit crunches, and their central banks, when they have central banks, will be not forced into QE, but they'll adopt QE as well. So QE is going to grow as a global phenomenon to keep asset markets from plunging. So we're going to stay in this artificial world of a central bank-dominated world, where the central banks are pulling the strings on a puppet they don't understand. Given that central banks have been doing QE to try to drive asset prices up, and they've succeeded in that, and when they go into reversal, they'll drive asset prices down because they believe asset prices should always rise. They will probably go back into QE again, and asset prices will continue rising because the QE is driven by the fact that the central bank is the only institution in any national economy that has an unlimited balance sheet. If any other private bank created as much money as the central bank is doing, then it would be vulnerable to a collapse in asset values, because when assets fall and your liabilities remain the same, you can end up in negative equity, and a private bank in negative equity is by definition bankrupt. But the central bank, and this has been acknowledged recently by a Bank of England research paper, a central bank can run negative equity. Nobody even knows effectively what the equity of the central bank is. So they can get away with this indefinitely. So the capacity of the central banks to go back in and continue boosting asset prices is frankly unlimited. So I think what's likely to happen is a stock market downturn when they try to reverse QE, and then diving back into QE again when they realise that they think they've got to keep asset prices rising. And if they stay on the buy side, which is what QE means they're doing, buying bonds, therefore causing private financial institutions to have to buy shares instead, that rally can go on indefinitely. Now we're already. This is the weird thing. The valuation of the stock market on Robert Shiller's excellent CAPE index is already at historic peaks that only are exceeded by 2000. We've got a higher price to share earnings ratio now than 1929, a higher one than 2007. So what we've got is a continuation of a Disney world. But it's not the real world. Because the central bank has got an unlimited balance sheet, they can dive in to rescue any fall in the stock market. If that's what they decide they have to rescue, then they can drive the stock market up. Now, you might see stocks hitting, let's say they're 30,000 on the Dow, and then the reversal of QE begins. You might see a 3,000 or 6,000 point fall in the Dow. Now, once that happens, the central bank will go into panic mode. Oh dear, reversing QE had more effect than we thought. What else can we do? Well, in the meantime, let's go back to QE again and get prices back up to 30,000 once more. And then what do we do with these bonds? Well, if we hang on to them long enough, they expire. Let's just hang on to them until they expire. So rather than reversing QE, they'll go into aging QE and letting it die that way. But I can see a dip in the stock market, but they will then dive back in and rescue it once more with their unlimited money creation capacity. That won't help the real economy all that much, but it will help keep Wall Street happy. I would like to see them go from QE for the banks to QE for the people. And I'm virtually certain that won't be tried by any central bank in the world. But if they did try it, they'd actually find it actually is a relatively smooth process, because the problem we have is the private sector's got too much debt and they can't repay it. The Japanese situation is very instructive on that front. Japan peaked at a level of private debt of about 2.25 times GDP. They're down to about 1.75 times now, but they've been bouncing between 1.7 and 1.6 for 10 to 15 years. What that means is that the Japanese corporations aren't borrowing to invest, so you're not seeing new Sony technology and new Toyota technology. The centre of innovation has moved for the moment to American and European corporations. So, but if you could actually reduce that debt burden, then suddenly the consumers who aren't spending would open their wallets again. They wouldn't be worried about more credit card debt. The firms that would like to invest but can't because of their balance sheet would suddenly realise they can, and need to get a stimulus to growth. Now, my example of that really is what happened after the Second World War. We didn't fight the Second World War to reduce the level of private debt. But in fact, the amount of money the government was spending was so great that private corporations and private individuals, with nothing to spend their money on, rationing was applying as well, drastically reduced their level of private debt from about, in America's case, from about 100% of GDP roughly when the war began to 30% roughly when it ended. And then everybody's worried about secular stagnation after the crisis. What happened? The biggest boom in America's history. Because suddenly credit wasn't a problem. You could borrow money. Everybody was financially solvent. And you had a boom in demand, which drove a boom in investment and innovation and gave you the best period of America's ever had, the golden age. So I believe that QE would have, for the people, would have a similar effect. It would work very well in reducing the debt burden, enabling investment to start happening again, enabling consumers to spend, and you'd have a booming economy. On the extremely unlikely prospect that I became Chief of the Federal Reserve, I would initiate what I call a modern debt jubilee. I would use the central bank's capacity to create money to make a per capita injection of money into people's bank accounts. I'd do a trial first of all. I would test how my spells work. But I might say every American who's got a bank account gets $10,000 in the bank account. Now, those who've got debt, that $10,000 would have to be used to reduce the debt. So that would be a direct way of saying, let's reduce the debt level. Those who don't have debt, I'd require them to use that money to buy shares. And I'd require the shares that were bought to be used to cancel corporate debt. And what you would then get out of that would be a reduction in the household debt level and the corporate debt level. You would have no particular change in the level of demand coming out of this, so you wouldn't need to worry about massive inflation. And you'd democratise, to some extent, the ownership of capital in America, which the Federal Reserve has made vastly more unequal by driving up the price of shares, which only benefits those who currently hold shares. My idea would increase the ownership of shares across the whole country and make America more capitalist and less feudal. My vision is, first of all, acknowledging capitalism as a mixed system, both state and market, both are necessary to be there. Also, it's fundamentally a monetary system and one out of equilibrium. It's always going to be a non-equilibrium state. We have to accept that and celebrate non-equilibrium because that's actually where change comes from. But get that fundamentally being in the real economy. We want that innovation and change in the real economy. Treat the financial sector as a servant, not a master. We've let the financial sector become a master, and in that process, the financial sector fundamentally makes a profit by creating debt. They sell you debt, they get a claim on your future expenditure. You have more money to spend now, but that's the Mephistopheles bargain you'll cut up with. The spending you get now gives you a burden on your future income. We have to reduce the level of the financial sector's claim on the real economy. That's the real parasite in capitalism, not capitalists, not workers, but the financial sector. And if you look back at ancient societies, they had the idea of a regular abolition of debt using debt jubilees. Now, we have a capacity to do that much more easily than they had through the fact the central bank can use its money creation capability to cancel levels of private debt that accumulate in the private sector between individuals and banks. And once we get that realization about the fluidity of money in that sense, we can stop this huge accumulation of debt occurring and stop that hobbling us. And we also have to focus upon not just GDP, but distribution of income. And if we get that right, we can have a well-functioning system. The trouble is ideology, particularly in the West, drives us to one extreme or the other. And what we find ourselves is doing, going from one crisis, we go too far in one extreme, off to the other crisis, the other extreme, we bounce between them. Let's just realise capitalism is a mixed market state system and get a bit of realism in here rather than ideology.